Hello. This is a worksheet that will show you the difference between purchasing stock and selling cash covered puts. And I believe it will demonstrate why we prefer to sell cash covered puts. Let's look at the stock side first. We're looking at Prudential, and currently the stock price is 103.75. It pays a $4.60 dividend, which gives it a 4.43% yield. And it's ranged from 60 to 109, so it's a little on the high side right now. And these prices are as of September 10th, 2021. From a capital requirement standpoint, if you own the stock, you're going to purchase 100 shares, and it's going to be $10,375. If we're selling cash covered puts, we're going to go with a strike price of $100, a little bit below where it's trading now. We're going to do one contract, which represents 100 shares. The premium they're paying is $4.40 per share, so the proceeds from the trade would be $440. And the expiration of this trade is 98 days out, or December 17th. So to annualize the income, we'll just take the $440 divided by 98 days times 365 days, and that'll give us an annual income number. So we've got an apples to apples comparison. From a capital standpoint, if we're going to do 100 shares at $100, it's $10,000, but they're paying us $440. So we're really going to tie up $95.60 in capital to cover this put. So it saves about 8% against what it would be if you bought the stock outright. So let's take a look at what happens a year later. And for the purpose of this exercise, we are going to exit both positions in a year. So let's say the stock doesn't change at all. It stays at 103.75. A year later, the only thing that really happens on the stock side is you get the dividend, so you've got a 4.4% yield. On the option side, we've sold this put almost 4 times because it's been a 98-day trade and yielding $1,639 or 16.4% in this instance. And the options are better off than stock by $1,179, so that's pretty strong. If the stock were to go up 5% and we sold it, we would have made $519 in stock appreciation and $460 on the dividend income. It's for a total of $979 or 9.4% return, which is good. The income from selling the cash covered puts doesn't really change. It's still $1,639. So options are better off than stock by $660. If the stock were to go up to 10% to $114, well, the stock appreciation would be just over $1,000. You'd get the same dividend for almost $1,500 or 14.4% return, which is strong. But once again, we would have made the $1,639 on the options, so options are slightly better than stock at $141. Now let's look what happens if the stock should go down. If the stock went down to 5% and we sold it a year later, we would take a $519 loss on the stock and made $460 on the dividends for a net loss of $59. On the option side, we would have to accept the stock in assignment at $100 a share, immediately sell it at $98.56 a share for a $144 loss, but we were paid $1,639 in premiums, so we've got $1,495 in income. So the options and selling puts is far superior stock ownership. If we move down to a 10% stock loss, where the stock drops to 93 and change, well, you'd lose $1,000 on stock loss. You'd make $460 in dividends, but you'd be down almost $600 for a 5.6% loss. On the option side, we would have to buy 100 shares at $100, immediately sell them for $93.38, taking the $663 loss on the stock, but we sold the options for $1,639, so we're still making almost $1,000, 9.8%. So we're far better than owning the stock. Should the stock go down 20% to $83, if you sold the stock, you'd take a $2,075 loss against the $460 in dividend income, losing $1,600 15.6%. On the option side, we would have to buy 100 shares at $100, immediately sell them at $83, losing $1,700, but we were paid $16.39, so our net loss is $61. So once again, options are far superior to stock ownership. You do have some ability to increase your yield here, but we didn't include it in this exercise. On the option side, you don't have to take assignment of the stock. You can always, what they call roll it out, push the position out a little further in time, make it another couple $100, and keep pushing it out in time. But the other thing that's important is the money that is set aside up here continues to earn interest in your brokerage account. So that's, or your 401k, so, or rather your IRA. So that's pretty important. So for these reasons, we feel that selling cash covered puts is superior to owning the stock. I hope that is helpful.